To see the matrix, you must first understand the two concepts that look identical, but are legal opposites: bailment and debt. Think about a coat check. You hand over your coat. You are property. The attendant gives you a ticket. They are a bailee. They are legally obligated to protect your specific coat and give it back to you. They cannot sell it. They cannot wear it. They cannot lend it to someone else. If you store your gold in a private, segregated vault, that is bailment. Now, think about your neighbor. You lend him $20. He gives you a verbal IOU. Is he obligated to keep your specific $20 bill in his pocket and give it back to you? No. He is obligated to give you an equivalent value any $20 at a later date. He is a debtor, and you are his creditor. For centuries, the public has been led to believe that the bank is just a high-tech coat check for our money. We think we are putting our money in the bank, but the bankers, they've always operated on the second principle. They know ... you are lending your money to the bank. This single semantic difference is the entire game. Because if you are just a creditor, the bank doesn't have to protect your money. They just have to be able to pay back their debt to you ... when you ask for it. And what if they used your money and lost it? What if they can't pay? In the 19th century, this question was just a theory. But one court case turned this theory into the ironclad law of the financial world. It was a ruling that, without fanfare, officially transferred the ownership of all deposits ... from the people to the banks. The trick began centuries ago with the goldsmiths of London. People had a problem. Carrying heavy, valuable gold and silver was dangerous. The goldsmiths had a solution. They owned the strongest vaults. Citizens began depositing their gold with the goldsmiths for safekeeping. In return, the goldsmith would issue a paper receipt, a note that said, "I owe the bearer 10 ounces of gold." These paper receipts were convenient. They were light, easy to carry, and most importantly, they were trusted. Soon, people stopped trading the heavy gold itself. They just traded the paper receipts. That receipt was money. The goldsmiths ... They observed that only a tiny fraction of depositors ever came back to redeem their gold at the same time. Maybe 10%? ... Maybe less. So the goldsmiths had an idea. A quiet, profitable, and revolutionary idea. What if they issued more receipts than the gold they held? What if they lent these new, unbacked receipts to other merchants and charged them interest? No one would know. As long as all the depositors didn't come back at once, the illusion would hold. This was the birth of fractional reserve banking. It was, in its essence, a confidence game. The goldsmiths were no longer bailies. Storing your gold, they were debtors who had commingled everyone's gold into one giant pot, and then leveraged that pot for their own profit. The entire system balanced on a razor's edge of public confidence, but it wasn't yet ... law. The year is 1848. A man named Mr. Foley had deposited a large sum of money with a bank, where it sat for several years. He later sued the bank. His argument was simple. The bank had used his money to make their own investments, and therefore, they owed him a share of the profits. Foley believed in bailment. He believed the bank was his agent, working on his behalf. The case, Foley v. Hill, went all the way to the highest court in the land, the House of Lords. The ruling would become the blueprint for all modern banking. Lord Chancellor Cottenham delivered the final judgment, and his words are the very definition of the money matrix. He stated, quote, "The money placed in the custody of a banker is, to all intents and purposes, the money of the banker, to do with it as he thinks proper. He is guilty of no breach of trust in employing it. He is not answerable to the principal. He is simply a debtor. There it is. Not a theory, not a conspiracy. The highest court in the land, in plain English. It is not your money. It is the bank's money. The moment you make a deposit, you are an unsecured lender. Your balance is not a thing. It is an entry on the bank's liability ledger. It is ... their IOU to you. This ruling opened the floodgates. Banks were now legally free to use all depositor money for their own speculative ventures. The fractional reserve system was now the law, and for the next 80 years, that system worked until it didn't. The 1930s. The Great Depression. The confidence game finally broke. Rumors of bank insolvency spread like wildfire, and people, the unsecured creditors, rushed to redeem their IOUs. This was the bank run. And for the first time, the public saw the truth. The vaults were empty. The banks had taken their deposits, their loans, and lost them in the stock market crash. Thousands of banks failed. Lifelong savings ... evaporated. The IOU was worthless. The public learned, in the most brutal way possible, the lesson of Foley v. Hill. The system had collapsed. The public's trust in the matrix was shattered. To save the system, the architects of the matrix needed a new tool. A tool of control. A tool that would restore confidence and make the public forget the truth. They needed ... insurance. In 1933, the U.S. government created the Federal Deposit Insurance Corporation, or FDIC. The premise was simple. The government would insure your deposits. If your bank failed, this government agency would step in and make you whole, up to a certain limit. It was a brilliant move. It stopped the bank runs almost overnight. It restored faith in the system. But what did the FDIC actually do? Did it change the legal reality? Did it overturn Foley v. Hill? Did it make the money in the bank your property again? No. All it did was insure the bank's IOU. It didn't fix the fundamental flaw. It just ... hid it. The FDIC is a confidence mechanism. It reinforces the matrix by making you feel safe. So you will continue to lend your money to the banks, allowing them to continue the exact same fractional reserve game that caused the crash in the first place. But now, with an explicit government backstop. But what is this insurance really? Let's look at the numbers. As of early 2024, the FDIC's Deposit Insurance Fund, the fund that protects your money, held approximately $125 billion. The total amount of insured deposits in the U.S. banking system, over $10 trillion. The insurance fund holds roughly 1.2% of the deposits it insures. It is not a fortress, it is a speed bump. The FDIC is designed to handle the failure of one or two small banks. To stop a local panic, it was never, ever designed to handle a systemic crisis. If a real panic started, if a too big to fail institution collapsed, that $125 billion fund would be evaporated ... in seconds. And in 2023, we got a preview. March 2023. Silicon Valley Bank. It wasn't a normal bank run. It was a digital one. Fueled by text messages and app-based transfers. Trillions of dollars in theoretical value. Demanding to be made real. All at one. The bank ... and its peer, Signature Bank, collapsed almost instantly. The FDIC's fund was never going to be enough. A huge portion of SVB's deposits were uninsured companies with balances far over the $250,000 limit. So, the Federal Reserve, the Treasury, and the FDIC held a weekend meeting and broke their own rules. They declared the systemic risk and, with a few keystrokes, announced they would guarantee all deposits, even the uninsured ones. Not with the insurance fund, but with the money printer. They created new money to backstop the bank's failed IOUs. This was a bailout, but it revealed a terrifying truth. The system is so unstable that the government must print money to keep it from collapsing. But this exposed the government to a new problem. What happens when the crisis is so big, ... that even the money printer can't fix it without causing hyperinflation? The architects of the matrix, they already have a solution. It's not a bailout, it's a bail-in. After the 2008 crisis, the G20 nations, including the US, agreed on a new set of rules. It's written into law in the Dodd-Frank Act. Here's the plan. When a too-big-to-fail bank is on the verge of collapse, the government will not use taxpayer money to bail it out. Instead, to recapitalize the bank. The bank will seize the funds of its creditors and convert that debt into bank stock, into ownership of a failing bank. And who are the lowest-ranking, most numerous, unsecured creditors on a bank's ledger? You. The depositor. A bail-in legally cancels your IOU. It takes your deposit, your money, and forcibly converts it into equity. Into stock. In a bank that is already bankrupt, your cash becomes worthless paper. This isn't a dystopian theory. This is the official, on the books, legal procedure. It happened in Cyprus in 2013, where depositors woke up to find 40% of their savings gone. Converted to bank stock. The bail-out ... was for the bankers. The bail-in ... is for you. The matrix has been upgraded. In 1930, when the bank failed, you lost your money. In 2024, when the bank fails, you become the owner of the failure. It's the ultimate trick. So, what have we learned? We've learned that the system we trust is an illusion. We've learned that the law, since 1848, has defined your deposit as a loan. We've learned that the insurance protecting that loan is a public relations tool, not an ironclad guarantee. And we've learned that the new rules, the bail-in, have officially placed the risk of the entire unstable, fractionally reserved system directly on your shoulders. So let's leave you with 3 simple takeaways. 1. A deposit is a loan. The moment your paycheck hits your account, you cease to be its owner. You are an unsecured lender to a highly leveraged financial institution. 2. Insurance is a tool of confidence, not capital. The FDIC is designed to stop your panic. It is not designed to survive your actions. 3. The bail-in is the new reality. The rules have been changed. The risk that used to be held by taxpayers' bailouts is now held by depositors. You are the backstop. The question is no longer if this fragile system will be tested, but when. And in that moment, millions will learn, all at once, the brutal lesson of Foley v. Hill. It was never their money. Now that you know you're an unsecured creditor. How does that change the way you see that number? On your screen, the first step to UNPLUGGING ... is seeing the code. The illusions of the money matrix are all around us. In the debt, we're told is normal. In the inflation, we're told is temporary. And in the money, we're told is real. If you're ready to see how deep the rabbit hole goes, subscribe to the Money Matrix and click the link here to watch our next deep dive. The 1971 glitch. The day money stopped being real and nobody noticed. Stay aware.